time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
DigitalOcean Holdings Inc., the symbol is DOCN. It's a NASDAQ company. It's trading about $33 per share right now, and it's an over $3 billion market cap company. What they do is they're a cloud computing platform provider, and they specialize in developer startups, small and medium-sized businesses. And they're a company that I'm familiar with. I've actually gone through many of their tutorials on their blog in the past. So I followed them. I was quite excited to see the results when they were out. I wanted to, evaluate how they were doing. And one of the reasons why I was excited is because the stock price has come down a lot. Now, they just went public. It was in, I believe it was in April of 2022. So they've not been public for very long. But after going public, the stock price May of 2021, the stock price just absolutely went parabolic in the first months of going public. And like most companies, they hit their peak. Most companies in the tech sector, they hit their peak. And around November, December of 2021, they gotten up to a price of close to $130 after IPOing at the, say the $33 range or $40 range, sorry. And then since then, it's just been straight down 74%. So trading now at about $33, below the initial IPO price. Now, they just put out their Q4 and year-end results. And if we look at the headline results, they look pretty good. In the fourth quarter, revenue of $162 million compared to $119 million last year. Earnings per share of 28 cents compared to 11 cents last year. So great growth in revenue and earnings there. And then for the full year, revenue growing to $576 million from $428, and earnings per share growing to 94 cents from 37 cents. So well over a double there in earnings per share. However, these are non-GAAP earnings per share. So these are adjusted. The company non-GAAP means that they do not conform to GAAP accounting rules. The company makes whatever adjustments they deem to make their earnings more comparable. So if we look at the GAAP, the accounting compliant figures, we can see that there's a big difference here. So just for example, for the year, non-GAAP income from operations of $102 million, non-GAAP. But if we go to GAAP, it's actually a loss of $26 million. So based on GAAP earnings, the company is not profitable. Negative 10 cents for the quarter compared to negative 11 cents in the same quarter last year. A net loss of 24 cents per share for the year compared to a net loss of 21 cents in the year before. And this is an issue that we've been talking about in the tech sector a lot lately, is the massive difference between a company's non-GAAP earnings and their GAAP earnings. And it's not necessarily that making adjustments to your earnings is a bad thing. Sometimes you need to make adjustments. There are a lot of things that can distort accounting earnings and make those earnings not be good representations of the economic value generated in the period, right? So some adjustments are fine, but it's when you see such a major difference between an adjusted earnings figure and a non-adjusted earnings figure, you really have to make some investigation into that. So what we would do is we would go to the reconciliation, which essentially tells you how the company gets from their GAAP to their non-GAAP figures, to figure out what is coming out of this. So for the year, as always, what we always see with these technology software companies is stock-based compensation is a major factor. So they paid $105 million in stock-based compensation last year. That was the biggest adjustment, right? So when you add that on to the $24 million GAAP-based net loss, that's how they get to a non-GAAP profitability. And there's a few other things in there too. There's some acquisition-related expenses. There is an impairment. There was some amortization of intangible assets. But really, it's that stock-based compensation that we're seeing as being the primary difference for almost all software companies when you're looking at GAAP earnings relative to non-GAAP earnings. And this is a topic that is debated a lot. I mean, Warren Buffett says you have to consider stock-based compensation to be an expense like any other. Some people are like, no, just take it out of there, ignore it. We like to look at both figures. There is a cost to issuing shares to your employees. Now, it's interesting to see how a lot of this is going to play out, because stock-based compensation has always been a major tool, so to speak, for technology companies to pay their employees, right? And a lot of employees would take stock in lieu of cash salaries, because the share prices of these software companies have been increasing so much. But now we're in a situation where most software companies have declined in price quite significantly. So getting shares is not as attractive as it once was. How is this going to play out? I don't know. But whenever there's a major difference between non-GAAP and GAAP earnings, or adjusted earnings and unadjusted earnings, you really have to be careful, especially when a company looks very profitable on an adjusted basis, but is losing a lot of money on a non-adjusted basis. You really have to consider both figures and not just blindly take the adjusted numbers, as many investors and analysts do. Okay. So anyways, great earnings, great growth on an adjusted basis, not making money on an unadjusted basis, but they do generate cash flow, fairly solid cash flow. The balance sheet. So taking a look at the balance sheet, cash and equivalents, 140 million, marketable securities, 723 million. So what are we at here? About 863, 864 in cash. But this company does have debt. DigitalOcean does have some debt, 1.5 billion in long-term debt, another 108 million in operating lease liabilities. We consider that debt as well. And not much shareholders equity. So 51 million in shareholders equity. Now, we don't typically look at the shareholders equity too much when we're evaluating a company. This is really an accounting figure. But at the same time, when a company has negative equity or very little equity, it's not ideal situation. So what does this mean? Well, that's another topic of debate. We would like to see a good, a fair amount of shareholders equity. In this case, it's 51 million, well below the net debt. The net debt being $714 million on this company. So financial outlook, they're looking for good growth in 2023. Total revenue, 700 to 720 million, and earnings per share, non-GAAP, $1.65 to $1.69. So the guidance looks great at face value. Well, a lot of technology companies are saying growth is going to slow substantially. Maybe it even flatlines. Maybe we even have slightly lower revenues. DigitalOcean is saying that they're going to continue to grow at a very strong rate. So what does all this look like in summary? Well, revenue growth based on the guidance would be about 23%. So they're looking at growing the revenue about 23% this year. Very impressive revenue growth, particularly in a market where, as I said, a lot of companies aren't expecting as much growth. Non-GAAP earnings per share growth, 78%. That's a fantastic growth rate if they're able to achieve it. And what this would be in terms of a price to earnings valuation for 2023 would be about 20 times non-GAAP earnings per share. Now, if we're looking at GAAP, I don't know, maybe they produce another unprofitable year. Maybe they are, producing GAAP earnings closer to non-GAAP. We don't know at this point, but they're only giving guidance for non-GAAP. So 20 times earnings, if we're just to take that at face value, I would say that's a very, very reasonable valuation for a company that's growing, expecting to grow revenue at 23% and earnings per share at almost 80%. However, as I said, we can't really just take that as face value, not completely. Cash flow, they did generate, I think, about 77 million in free cash flow in 2022. That puts the valuation of 41 times free cash flow. Not super cheap, not at all. Given the growth rate, maybe you could argue that it's reasonable long-term, but it's certainly a premium. And there are other companies that we see that have price to free cash flow ratios at that level or slightly below that we think are growing, at equally impressive rate and, maybe have better fundamentals in other areas. But one area that I really don't like about the company is when I look at that balance sheet. So if I were to take that net debt of 714 million, do a net debt to adjusted EBITDA multiple, we get to 3.6 net debt to adjusted EBITDA. And this is adjusted EBITDA. Again, if we were to just use regular EBITDA unadjusted, we may not even be working with a positive value. Not 100% sure. But let's just assume we can just take the adjusted EBITDA at face value. Net debt to adjusted EBITDA 3.6 times, that's fairly leveraged, particularly for a software company. Now, a lot of the software companies that we look at, like the Fortinets, the EPAMs, the Microsofts, the Googles, they actually have net cash on their balance sheet. So it's not even a net debt. Their net debt to adjusted EBITDA is nothing because they have no net debt. They're dealing with net cash. So that's typically what we like to see in a lot of companies in the software space have that net cash balance. So I would consider this to be a fairly levered balance sheet for a software company, approaching 4 times. I'm not super comfortable with that. And then the debt to equity 14 times, that's a huge ratio. That indicates high leverage. Again, we don't really use the shareholders' equity value that much because it is such an accounting term, but still 14 times debt to equity, I can't say that that's something that I like to see. And actually, you want to know what? That's actually net debt to equity, which it should actually be total debt to equity. So we would probably double that, I believe. So it'd be like about 28 times. So yeah, in summary, you want to know what I think DigitalOcean, it's got a lot of interesting attributes to the business. As I said, I know it as a stock. I know it as a follower of some of their tutorials, but I think that there's better companies to invest in. There are companies where there's not such a differential between the adjusted and the non-adjusted EPS. Companies in the software space that have, really strong growth, maybe similar to this, that are still GAAP profitable and that have much better balance sheets. So we'll continue to follow the company, but based on the fundamentals of what I'm seeing, I would say that we're not going to be in any hurry to invest.
My biggest takeaway would be there's a huge gap between the GAAP and the non-GAAP earnings. And that's a lot of gap. But it actually is. Funny as that is.
I love it.
I know that's hilarious. But it is true that there is. And that is the crux of the argument, really, right here when we're talking about the company. I also read the company, they have a buyback program. They actually bought back 600 million worth of shares, I believe, in 2022. But despite that buyback, there were still more shares outstanding at the end of 2022.
Yeah, and buying back with what?
Yeah.
They've got got a ton of debt
at some point,
right?
Yeah.
So I don't know. Like if you're sitting there, if you're one of those net cash businesses, like say Fortinet,
and as your share price is doing this too.
Yeah,
so.
Fortinet's company in cybersecurity, like they've got net cash, right? They're buying back a lot of shares too. That I can understand. But if you have a ton of debt and you have a balance sheet that's already over levered, in my opinion, I don't know. Maybe you should work on paying down the debt.
And because of the share-based compensation, they still ended up with more shares at the end of the year, and they've authorized a $500 million buyback in 2023.
Right. So let's look at that from like that share-based compensation perspective, and like, well, is this actually a cost? Like the cost is they spent a bunch of money buying back shares and they still ended up with more shares. So there is a cash cost, right? If you're going to compare the capital structures, right? Yeah, I mean, it's
if you look at their guidance too, they have projecting more shares outstanding at the end of 2023 than at the start of the year. So you're buying back likely quite a bit of shares. You're still ending up with more shares. So there's your cash cost. You can see it. And, I mean, yeah, we're not saying this company is the worst company in the world, but
we're just not
if you were to compare. Yeah, if you compare this company to like other companies that have actual earnings, right? And there's obviously debate as to whether the quality of this company's earnings, the non-GAAP earnings, but you can compare to some that you can find that maybe are growing at 15 to 20% that are trading at 15 to 20 times earnings, but it's actual GAAP earnings, maybe a different sector, right? But likely not as leveraged, then you're weighing that against investing in this company, even though the company's shares are down 74%. So, and at one point they were, started the year,
And that's
and
another
last year
point that I
down
wanted to
significantly
make is
more.
like when you look at that 20 times non-GAAP EPS multiple, price to earnings multiple, I don't even consider it, given all the other things we talked about, that to be especially cheap. But the company has grown its earnings and the share price has declined. So what was that multiple at the peak when it was trading close to $130? 3 times, maybe 4 times that amount, possibly. I mean, certainly 4 times that amount, probably. So some will say, well, they've grown their earnings, the share price is down 75%, the value must be good. It's actually not. You're now just getting to a point where you can be like, okay, the value is starting to get into that range where it's not completely ridiculous, where it's starting to get reasonable again. You're not, and this is what we've seen with a lot of those software companies.
And
In
based
some
on
cases, down
non-GAAP is what you're
90%.
saying too.
What's
Yeah.
that?
And based on non-GAAP, it's starting
And
to be more
that's
reasonable.
also just taking the
That's just,
non-GAAP and not, which we don't want to do. So I don't know.
Yeah. And based on the free cash flow, it was just, it was still kind of expensive
It's
given a
still kind of
23%
expensive.
growth rate. Yeah.
I mean, if it's
That's a
growing
good
their free
summary.
cash flow at 80% every year, then no, but
Yeah.
there's
But
the risk.
it's difficult for any company,
Yeah.
even the greatest, to do that. So